Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023, October-November, Paper 3-3, question number 1. This is the structured Paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour and 30 minutes, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question under 30 minutes. So without any further delay, let's get started. The statement of financial position of KPLC at 30 June 2022 showed a total carrying value, which is just going to be the net book value. And this is for property, plant and equipment. And we have the carrying value of 620,000. This is at the date of 30 June 2022. This consisted of premises, machinery and motor vehicles. As part of the preparation of the financial statements at 30 June 2023, the company needed to prepare the schedule of non-current assets. And we have been given the information for premises. We have the information for machinery as well as motor vehicles. Let's have a look at our first question. So for the first part, we need to complete the following table by calculating the required values for each category of property, plant and equipment. And this is at the date of 30 June 2022. And we were told that the total of the carrying value for premises, machinery and motor vehicles for 30 June was 620,000. It's given right here. Then we need to use the space provided to show our workings for premises, machinery and motor vehicles. And for this part, we require the cost, accumulated depreciation and the carrying value. Let's start with the information given for premises. So the premises had been bought on 1st July 2007 for 480,000, which means that this will be our cost. At that time, the cost was considered to be 50% for land, 50% for buildings. So 50% of 480,000 will be the value for land and 50% for 480,000 will be the value for buildings. This is important because we do not apply any sort of depreciation for land. We will only be applying the rate of depreciation towards the value of buildings. Then it is the policy of the company to depreciate buildings at the rate of 2% per annum using the straight line method. So we will be applying this 2% only for 50% of this cost. So 50% of 480,000 is just going to be 240,000. So this is the value at which we will be applying the 2% rate of depreciation. And on 1st July 2022, remember that we are preparing our cost, accumulated depreciation and carrying value table for the year ended 30 June 2022, which means that at the date of 1st July 2022, this will be part of the next year, which is going to be the year ended 30 June 2023. So we're not concerned with this part right now. So we're just going to skip this for now, which means that within our cost, we have to input the value of 480,000. Then we need to show the accumulated depreciation as well. Okay, let's just write down the cost, 480,000. Now for the calculation of accumulated depreciation, remember that we are only applying the depreciation for 50% of the value of cost because that's the cost of our building. And we've already figured it out to be 240,000. We were also told that the rate of depreciation will be 2%. But this is just going to give the depreciation charge for 1 year. But we're trying to calculate the accumulated depreciation, which means that we first need to calculate the number of years. And we were told that it was bought on 1st July 2007. So it will complete 1 year of use at the date of 30 June 2008, right? So 2008, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So we're using it for a total of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So we're using the premises with a cost of 480,000 for a total of 15 years till the date of 30 June 2022. So the depreciation for those 15 years is just going to act as the accumulated depreciation. And we already know that 240,000 times 2% is going to give the depreciation charge for 1 year. So for 15 years, we can just multiply it by 15. And this will give the value of accumulated depreciation to be of 72,000. Now we have the cost as well as the accumulated depreciation, and the carrying value is just going to be cost minus accumulated depreciation. In this case, that's going to be 480,000 minus 72,000, which results in 408,000. Okay, now let's move towards the information given for machinery. This is on 1st July 2022. The company operated 4 machines. these had all been bought for the same prices. And again, remember that this is for the next year's opening date. Machines 1 and 2 were fully depreciated by 30 June 2022. So this just means that within our table for question number 1, the cost of machine 1 and machine 2 is going to be equal to their accumulated depreciation because they are fully depreciated. Then machine 3 had been bought on 1st July 2014 and on 30 June 2022 had a carrying value of 12,000. So we have the carrying value of machine 3, and we were told that all of these machines had been bought for the same price. So the cost of machines 1, 2, 3 as well as 4 is going to be the same value. And in this case, we have been given the carrying value. And okay, let's go through all of the information first. Machine 4 had been bought on 1st July 2016 and on 30 June 2022 had a carrying value of 24,000. Then the company depreciates its machines at the rate of 10% per annum using the straight line method. It provides a full year's depreciation in the year of acquisition and none in the year of disposal. During the year ended 30 June 2023, okay, this is for next year, so we're not going to use this information for the first part. Okay, now the very first thing that we need to do is to figure out the cost, and we can just utilize the information given for machine 3. So we were told that machine 3 had been bought on 1st July 2014, and till the date of 30 June 2022, let's figure out the number of years that the company has used this machine for. So the first year will end at 30 June 2015, then there's 16, 17, 18, 19, 20, 21, 22. That gives us a total of 8 years. Okay, so there's the accumulated depreciation of 8 years, and after subtracting that accumulated depreciation, we get the carrying value of 12,000. And we're also told that the depreciation rate is 10% per annum using straight line method. Let's create an equation in order to calculate the cost. So just remember that cost minus the accumulated depreciation will be equal to the net book value, right? In this case, for machinery 3, our accumulated depreciation is just going to be cost times 10%. This will give the depreciation charge for 1 year. And we've already calculated that machinery 3 had been used for 8 years. So in order to calculate the accumulated depreciation, we just need to multiply the depreciation charge per year by 8. And this gives the net book value, which is the carrying value given in the question to be of 12,000. So cost minus 10% times 8 is just going to be cost times 20, because if you take cost common, that's just going to be 1 minus 10% times 8, which will be 20%. Now we can easily figure out the cost of each machinery. That will just be 12,000 divided by 20%, which is 0.20. This gives the value of 60,000. And remember that we have 4 machineries at the date of 30 June 2022. So the total cost is just going to be cost of 1 machinery times 4, which gives the value of 240,000. Now, we were given the carrying value of 2 machineries, right? Machinery 3 and 4, we have the carrying value of 12,000 and 24,000. And remember that the machines 1 and 2 were fully depreciated, which means that their cost will be equal to accumulated depreciation, due to which their carrying value is just going to be 0, which means that the net book value will be 0. So the total of the carrying value that we should include within the table is just going to be the carrying value of machine 3 and 4. So that's 12,000 plus 24,000, which results in the value of 36,000. Now we have the cost as well as the carrying value. We can easily figure out the accumulated depreciation. So cost minus accumulated depreciation is carrying value. In this case, we have the total cost of 240,000. We're trying to figure out accumulated depreciation. The carrying value is 36,000. Now the accumulated depreciation is just going to be 240,000 minus 36,000. This results in the value of 204,000. That's the accumulated depreciation for machinery. Okay, now let's move towards the information given for motor vehicles. So for motor vehicles, on 1st July 2022, which is next year's opening date, so this is equivalent to current year's closing date, the motor vehicles had a cost of 250,000. So we can just write this down as our cost. Then there were no acquisitions during the year. So again, this is the information for next year. We don't need this for the first part. Now for the first part, we can easily calculate the carrying value for motor vehicles because we have been given the total of the carrying values, right? So let's create an equation. So the carrying value of premises was 408,000. The carrying value of machine was 36,000. We're trying to figure out the carrying value of motor vehicles. And we also have the total of the carrying value, which was given to be 620,000. Now, the carrying value of motor vehicle is just going to be 620,000 minus 408,000 minus 36,000. This gives a value of 176,000. Again, we're going to repeat the same process that we did for machinery in order to calculate the accumulated depreciation. So cost minus accumulated depreciation is the carrying value. We already know that, which means that accumulated depreciation is going to be cost minus carrying value. In case of motor vehicles, that is just going to be 250,000 minus 176,000, which results in 74,000. That is all for our first part. Let's move towards the second one. We now need to prepare the schedule of non-current assets to use as a note to the financial statements for the year ended 30 June 2023. We need to use the space provided for workings on page 4 to show all of our workings. Okay. So remember that we have 3 different non-current assets and we also need a total column. Okay, we are preparing this schedule of non-current assets for KPLC. You need to specify that this is the schedule of non-current assets. This is at the date of 30 June 2023. And remember that the non-current assets given are the property, plant, and equipment. Okay. So we also need a total column. Then we have motor vehicle. We had machinery, we had premises. And this is a schedule of non-current assets which can be divided into 3 different sections. So we're going to start with our first section, that's the cost. So in this section, we will only be including the cost of these 3 non-current assets. And remember that our closing date is 30 June 2023, which means that the opening date is 1st July 2022. And for each of the section, we always start with the opening value. So that will be at the date of 1st July 2022. And this is just the closing value of last year, right? And at the closing value, we've already calculated the cost in this column. So we're just going to include the value of premises as 480,000. For machinery, it's going to be 240,000. And for motor vehicles, that will be 250,000. Let's write it down. So for premises, we have 480,000. For machinery, we have 240,000. For motor vehicle, we have 250,000. And the total is just going to be sum of these 3 values. So 480 plus 240 plus 250 results in 970. And remember, within the cost section, we have to include 3 different items. So the first one will be acquisitions. Acquisitions is just going to refer to purchase of new non-current assets. And again, this is the cost section, so we will be including those purchases at its cost value. And for this one, we need to refer to the information that we previously labeled as the information for next year. Let's have a look at premises. For premises, on 1st July 2022, they were revalued. So this is not part of the acquisition, this is part of revaluation. Let's go through the information. The valuation was 790,000, with 390,000 of this being the value of the land. So the total new value of premises is 790,000. And since we're talking about cost, this should be our new cost at the ending date, right? So we need to figure out the difference between the previous cost and this new cost as part of the revaluation upwards. So that's just 790,000. That's the new value minus the previous value of 480,000. This gives the value of 310,000. So this should be included within our evaluation section for our cost for the premises column. Okay, so the first one is acquisitions. Second one will be disposals. This deals towards the sale of all of our non-current assets, and then there's revaluation. And there's revaluation for premises of 310,000. The last one is the value at our closing date of 30 June 2023. So for premises, we can see that the closing value will now be 480,000 plus 310,000, which gives the revalued amount of 790,000. let's take a look at the information for machinery. For machinery, during the year ended 30 June 2023, for which we are preparing this schedule of non-current assets, the 2 fully depreciated machines were sold at a profit of 36,000. So these will be part of our disposals, right? And again, we are talking about cost section, which means that we just need to subtract the cost of the machines that were disposed. And we disposed machine 1 and 2. And remember, the cost for each of these machines was 60,000. So for disposal, that is just going to be 60,000 times 2. So we're just going to subtract 120,000 under the heading of disposal for our machinery. So for disposals, we have to subtract the cost of the machinery that were sold. Then there's also another information. 2 new machines were bought. So this is part of our acquisition at a cost of 90,000 each. And there's 2 machines. So 2 times 90,000 will give 180,000. That's the actual cost. We have to include that under our heading of acquisitions. So that's plus 180,000. That's all for machinery, which means that the closing value for machinery will be 240,000 plus 180,000 minus 120,000, which results in 300,000. Okay, now let's have a look at the information for machinery. There were no acquisitions during the year, but 1 vehicle with an original cost of 80,000 was sold. So again, we have to remove the cost of the sold vehicle. We just have to subtract 80,000. So under disposals, that's minus 80,000. Which means that at the closing date, the value of motor vehicle will be 250,000 minus 80,000, which results in 170,000. Let's calculate the total. Total for acquisition is just going to be 180,000. The total for disposals will be 120,000 plus 80,000, which results in 200,000. Again, this should be subtracted. And the total for revaluation will be 310,000. So now the total will be 970,000 plus 180,000 minus 200,000 plus 310,000, which results in 1,260,000. That's the cost of all of our non-current assets at the closing date. This completes the first section. Now the second section deals with depreciation. Again, we first start with the accumulated depreciation at the opening date, which is at 1st July 2022. This is again included within the first part. So we've calculated the accumulated depreciation for all 3 assets. So that's just going to be 72,000, 204,000, and 74,000. And the total is just going to be 72,000 plus 204,000 plus 74,000, which results in 350,000. Now, within our depreciation, we first have to include the depreciation charge for the year. Then if there was any disposal, for those disposed non-current asset, we now have to remove their accumulated depreciation. So we can just write it under the heading of disposals. And if in cases of revaluation, we need to subtract the accumulated depreciation before the date of revaluation. So again, that needs to be included under the heading of revaluation. And that will give our accumulated depreciation at the closing date of 30 June 2022. So for our premises, we can see that there was revaluation, which means that we need to subtract any associated accumulated depreciation before the revaluation date. And the revaluation was done on 1st July 2022. So any accumulated depreciation on that date should be subtracted. We can see that at 1st July, we have the accumulated depreciation of 72,000. Due to revaluation, this will now be removed. So we just have to subtract the 72,000 under the heading of revaluation. Now we also need to include the depreciation charge for the year for our premises. We need to calculate that. So remember that our valuation was of 790,000. That's for land as well as building. But remember that only buildings will be depreciated. And in this case as well, it was decided to continue to calculate depreciation on buildings at the rate of 2% per annum. So the depreciation for this particular year, we first have to figure out the cost of our building. And in this case, 390,000 was the value of land. So if we subtract this from the total value, we get the value for our building. So that is just going to be 790,000 minus 390,000. That's our cost of the building. Now if we multiply it by the rate of depreciation, we get the depreciation charge for the year. This gives the value of 8,000. So we need to add this under the heading of charge for the year within our premises. And there were no disposals, so we can calculate the accumulated depreciation at the closing date. That's going to be 72,000 plus 8,000 minus 72,000, which results in 8,000. Now, for our machinery, again, there were disposals, right? And these were disposed for machines 1 and 2, where their cost was equal to the accumulated depreciation because they were fully depreciated. And we need to subtract the accumulated depreciation in this case, right? So the cost was equal to accumulated depreciation, which means that we just need to subtract the same value of 120,000. Okay, now let's calculate the depreciation charge for the year for our machines. And the rate of depreciation was 10% per annum using straight line method, right? We know that machine 3 and 4 had the cost of 60,000 each. So that's 60,000 plus 60,000, which is also 120,000. And then new machinery were purchased for 90,000 each. So that's again 90,000 plus 90,000, which is also 180,000. Now that gives our total cost. If we multiply it by 10%, that will give the depreciation charge for the year. This results in the value of 30,000. Let's write it down. Okay, there were no revaluation for machinery. So our closing accumulated depreciation value is just going to be 204,000 plus 30,000 minus 12,000 minus 120,000, which results in the value of 114,000. Now for our motor vehicles as well, we disposed the motor vehicle costing 80,000, and we were given information regarding it. We were told that it had an original cost of 80,000 and it was sold for 58,000, that's the sales proceeds, and there was loss on disposal of 1,200. So in order to calculate the accumulated depreciation, we first need the net book value. In this case, we have loss on disposal. So loss occurs when the net book value is higher than the sales proceeds, right? The loss value is 1,200 in this case. We're trying to figure out the net book value. The sales proceeds was given to be of 50,000. So this gives our net book value to be of 51,200. Now we have the original cost as well, right? So cost minus accumulated depreciation is the net book value. We are trying to figure out the accumulated depreciation in this case. So the cost is 80,000 minus accumulated depreciation will be equal to 51,200. And this gives the accumulated depreciation to be of 80,000 minus 51,200. So the accumulated depreciation of the disposed motor vehicle is just going to be 28,800. So we now need to remove it. So under the heading of disposal, we're just going to subtract 28,800. Okay. Then there were also additional information. The accumulated depreciation on 30 June 2023, that's the closing date, was known to be 70,160. So at the closing date, it's 70,160. So now we have to create an equation in order to figure out the charge for the year. So that's 74,000 starting accumulated depreciation plus charge for the year minus the disposal of 28,800 should be equal to 70,160. So the depreciation charge for the year is just going to be 70,160 minus 74,000 plus 28,800, which results in the value of 24,960. That's the depreciation charge for the year. Okay, let's figure out the total depreciation charge for the year. That will be 8,000 plus 30,000 plus 24,960, which results in 62,960. The total for disposal is going to be 120,000 plus 28,800, which results in 148,800. And this should again be subtracted. For revaluation, that is just going to be 72,000. And the total will be 350,000 plus 62,960 minus 148,800 minus 72,000, which results in 192,160. That completes our second section. Now for this third section, we just need to include the carrying value. We first include the carrying value at the closing date. So carrying value at 30 June 2023. Then we'll also include the carrying value at the opening date, which is at 1st July 2022. And we do not have to calculate the carrying value at the opening date because that we've already included within the first part. Right here, we can see that's 408,000, 36,000, 176,000, and the total is 620,000. So at our opening date For premises, that was 408,000. For machinery, that was 36,000. For motor vehicles, that was 176,000. And the total was of 620,000. Now for the carrying value at the closing date, remember that carrying value is just cost minus accumulated depreciation. So we have the cost at the closing date right here. We have the accumulated depreciation at the closing date right here. So for our premises, that is just going to be 790,000 minus 8,000, which is also in 782,000. For our machinery, that's going to be 300,000 minus 114,000, which is also in 186,000. And for our motor vehicles, that will be 170,000 minus 70,160, which is also in 99,840. Now the total for the carrying value at our closing date is going to be 782,000 plus 186,000 plus 99,840, which is also in 1,067,840. Okay, that's all for our schedule of non-current assets. And remember, you need to show your workings in the box below. So that should include the workings for this charge for the year for our motor vehicles. Then it should also include the workings for your net book value of the disposed motor vehicle, as well as the accumulated depreciation of the disposed motor vehicle. And it should also include the calculation for depreciation charge for the year for machinery, as well as the depreciation charge for the year in buildings. That completes the second part. Let's move towards the next one. KPLC's accountant had faced additional challenges in preparing the financial statements for the year ended 30 June 2023. Some of the ledger accounts for the non-current assets had been accidentally deleted from the computerized accounting system by a junior member of staff. Okay, and now we need to state one implication of this for each of the director and the auditor. Let's talk about directors. The directors are the senior management of the company, right? So when a junior member of staff accidentally deleted the ledger accounts for the non-current assets from the computerized accounting system, I think the implication for directors would be that they should invest more in staff training, right? Let's write it down. Invest more in staff training. Then we have the implication for auditors. So again, auditors will probably advise the directors to improve the accounting system so that this accident might not take place in the future. So might advise the directors to improve the accounting system. Okay, this completes the first question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.